What if everything your parents taught you about money was designed to keep you poor? Not because they were wrong, not because they were foolish, but because the rules quietly changed and nobody told you. Here's a question. Imagine two people walk into the same dealership on the same day. They both want the same car, a $45,000 SUV. Both of them have the money sitting in a bank account right now. Person A pulls out their checkbook, pays cash, drives away. No loan, no interest, no monthly payment. They feel incredible, debt-free, financially responsible, just like they were raised. Person B walks in, puts $5,000 down, finances the rest, and drives away with a monthly payment. 1 year later, Person A has paid $45,000 for a car. Person B, they've paid roughly $9,000. And in many states, they've quietly received a tax deduction, preserved capital that earned them returns in the market, and shielded a significant portion of their net worth from a tax exposure that Person A triggered the moment they signed that check. Who made the smarter financial decision? The answer will probably make you angry. And it should. Because what's happening in 2026 isn't a glitch in the system. It's the system working exactly as it was designed, just not for the person paying cash. Stay with me, because by the end of this video you'll understand why the wealthiest people almost never pay cash for depreciating assets, and why doing so in 2026 specifically may be one of the most expensive financial mistakes you can make. To understand why cash is now a trap, you need to understand the world that made cash feel like a crown. Go back to the 1970s. Inflation is raging. Interest rates are climbing toward numbers that would make your stomach drop. By 1981, the Federal Reserve under Chairman Paul Volcker raised the federal funds rate to 20%. 20. Taking out a loan to buy a car during that era wasn't smart. It was financial self-destruction. You were paying a fifth of the loan's value every single year just to borrow money. The cultural message was burned into an entire generation. Debt is the enemy. Loans are chains. Pay cash whenever you can, and you'll be free. And for a very long time, that was largely correct. But here's what nobody talks about. That economic environment no longer exists, and yet the cultural programming from it still does. Fast forward to the 2010s. Interest rates hit historic lows. The Fed dropped the federal funds rate to essentially zero. Suddenly, borrowing money became almost free. Meanwhile, the stock market was delivering average annual returns of 10 to 14%. The mathematical equation flipped completely. In that world, paying cash for a depreciating asset, a car that loses value, the moment you drive it off the lot, was no longer discipline. It was, mathematically speaking, a wealth-destroying decision. But the psychological programming didn't update. The bumper sticker logic, if you can't pay cash, you can't afford it, lived on. And then 2026 arrived, and three things converged to make cash purchases not just suboptimal, but an active tax liability. Here's where the story gets complicated, and here's where you need to pay attention. How the tax code became a weapon you didn't know about. Most people think of taxes in one direction. Income comes in, the government takes a piece. Simple. What most people don't realize is that the U.S. tax code, all 6,971 pages of it, is also an instruction manual. It tells you in legal detail exactly how to reduce what you owe. And buried inside are provisions that treat borrowing money very differently from spending it. Here's the foundational concept you need to understand. Depreciation. When a business buys an asset, a piece of equipment, a vehicle, property, that asset loses value over time. The IRS allows businesses to deduct that loss in value from their taxable income. This is called a depreciation deduction. Now here's where it gets interesting for car buyers. Under Section 179, a qualifying vehicle used for business purposes can be immediately expensed, meaning the full purchase price can be deducted from business income in the year it's purchased, rather than spread over 5 or 6 years. If you're a contractor, freelancer, or real estate investor, you may be able to reduce your taxable income by the full cost of that vehicle. But here's the trapdoor. When you pay cash for that vehicle, you've already spent the money. You've deployed your capital. Your liquidity is gone. The wealthy do something different. They finance the vehicle, take the deduction, keep their $45,000 invested, and let returns pay the car payment. Let me say that again slowly. They get the tax deduction, they keep the cash. The investment returns cover the loan. At the end of the term, they've driven the car and captured the depreciation. Their $45,000 has grown in the market. The person who paid cash, their capital is sitting in a machine worth $29,000 5 years later. It didn't earn, it depreciated. This is not a loophole. This is the tax code functioning exactly as Congress designed it, to incentivize capital retention and investment. Why 2026 made this worse than ever before? What changed in 2026 specifically? 3 things happened simultaneously. First, interest rates have moderated, but high-yield alternatives haven't. Auto loan rates remain available at competitive rates. In some cases, borrowing costs are below the historical average return of a diversified index fund. When borrowing costs are lower than investment returns, financing isn't just acceptable, it's mathematically superior. Second, the capital gains environment has tightened. Changes in how unrealized gains are treated in some states, combined with increased IRS enforcement of high-income filers, mean that liquidating investments to pay cash for a vehicle can now trigger a taxable event. Think about what that means. If you have $45,000 in an investment account, and that account has grown, selling those positions to pay cash for a car doesn't just cost you $45,000, it costs you $45,000 plus the capital gains tax. In a high-tax state, that could be an additional 20 to 33% on your gains. You just paid a tax premium to avoid a loan. Third, the depreciation window is closing for some vehicle classes. Bonus depreciation provisions have been phasing down. In 2026, understanding the exact current bonus depreciation percentage and how it interacts with the vehicle's classification is more important than ever. Those who act strategically now with proper financing structures may capture deductions that won't be available in the same form in 2 or 3 years. The perfect storm is here. Moderate borrowing costs, capital gains exposure on liquidated assets, and a closing window on depreciation benefits. Paying cash in this environment isn't financially neutral. For many people, it's actively harmful. A physician in California, Dr. Reyes, pays cash for a $62,000 luxury SUV in early 2025. She's proud. No debt. Clean conscience. What she doesn't realize until her accountant calls, she triggered $18,000 in capital gains taxes on the stock sale. And her $62,000. It's now a vehicle worth $47,000 sitting in her driveway. The capital is locked. It cannot compound. Her colleague financed his $62,000 vehicle at 4.9% over 60 months, left his investment portfolio untouched. His portfolio returned approximately 11% that year. His loan payments were $14,000, but the deduction returned $21,000 to him in tax savings. Net position? He's ahead. Significantly. Same car, same income, same tax bracket, completely different financial outcome. The tragedy is that the people who were raised to hate debt are often the ones paying the heaviest price. Because discipline, in a system that rewards strategic borrowing, can become its own trap. The quiet wealth gap. Nobody talks about. Here's the part of this story that should make every middle-class earner pay attention. The people who understand the financing versus cash equation are almost exclusively in the top income brackets. Not because the strategy is restricted to them, it isn't, but because wealthy individuals have access to advisors who teach them this. They have CPAs who optimize every major purchase through the lens of tax efficiency. They have financial planners who run these scenarios before any significant transaction. The middle-class earner, raised on cash as king and never go into debt, is making major financial decisions. They are based on cultural wisdom that was accurate for a different economic era. And the gap compounds, over a working lifetime, assuming a new vehicle every 5 to 7 years, the difference between strategic financing and reflexive cash payment. When properly modeled for opportunity cost and depreciation optimization, the difference can run into hundreds of thousands of dollars. Not because cash buyers are foolish, but because the system is not neutral. It has preferences, and its preferences are for those who borrow strategically, invest the difference, and let the tax code work for them. The cash buyer funds the whole system out of pocket and gets no structural advantage. The strategic borrower lets the tax code, the market, and low-cost capital do the work. That gap, multiplied over decades, is part of how wealth concentrates. Quietly, legally, without fanfare. Why every instinct you have about this is probably wrong. The instinct to pay cash feels right because it mirrors a fear, the fear of obligation, interest, and being owned by a payment. But consider where that fear comes from. It was built in an era of 18% auto loan rates, when inflation was eroding savings and stock market returns were unreliable. That fear made sense then. It's an evolutionary mismatch now. It's the financial equivalent of refusing a seatbelt because your grandfather survived without one. The fixes people try are often misguided. I'll pay cash and invest whatever I would have paid in monthly payments. But it ignores the opportunity cost of the capital already deployed and the lost deductions already missed. You're investing instead of the car payment, but you already gave up $45,000 in working capital on day one. I'll lease instead of buy cash or finance. Leasing has its own strategic applications, but it removes ownership equity. In many cases, it restricts how business use deductions can be applied. For the wrong buyer, it can be worse than both options. The data in 2026 is clear. Americans who finance vehicles and invest the retained capital in diversified index funds outperform cash buyers on a net worth basis over 5-year periods when interest rates remain below historical market returns. The Federal Reserve's own consumer finance surveys show that liquid asset preservation correlates with long-term wealth accumulation. The pattern repeats in every economic era. Those who understand the cost of capital, the value of liquidity, and the architecture of the tax code build wealth. Those who follow inherited rules without examining them often fund the wealth of others. Let's land this with precision. Takeaway 1. The cost of cash is not zero. Every dollar you spend for a depreciating asset is a dollar that cannot compound. If your capital can earn more in the market than your loan costs in interest, financing is not a concession. It's a strategy. Takeaway 2. A car purchase is a tax event. Treat it like one. Consult a CPA who understands Section 179 and bonus depreciation. The IRS code has rules for this. Learn them or pay someone who has. Your financial instincts were built for a different world. In 2026, interest rates are moderate, market instruments are accessible, and the tax code structurally rewards strategic borrowing. Updating your instincts is responsible. The financial system is not designed to be fair. It's designed to be navigable, but only if you know the map. Debt is a tool. Like any tool, it can build a house or take your fingers off depending on how you use it. The question is whether borrowing serves your long-term position. That is a math problem, not a moral one. If this video changed your thinking, share it. Subscribe for rigorous, no-hype financial content. We just follow the math. See you next time.